JP Morgan's Chase said that the overall, the global allocation to precious metals and precious metals equities in the US was only 0.5%. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a fourfold increase in demand. I have no idea what a 20% market share, which would be a 40-fold. 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil.
For investors who have watched gold and silver move in fits and starts over the past decade, Rick Rule's latest remarks deserve careful attention because they force us to confront a simple arithmetic problem with enormous implications. The current allocation to precious metals in U.S. portfolios is minuscule, a fraction of a percent, and even modest reversion toward long-run norms would translate into multiple times the demand we see today. Put differently, the market is starting from a very small base. Small percentage moves in allocation translate into very large flows into both physical metal and precious metals equities, and that asymmetry is what underpins the bullish case Rick lays out. Rick frames this opportunity within a macro picture that few investors can afford to ignore: a sustained erosion in the US dollar's purchasing power, persistent inflationary pressure, and real yields that are unattractive for long-term savers. Those forces, combined with the structural under-allocation we just mentioned, create a long-run tailwind for gold and, to an important extent, for silver and the mining equities that produce them. That does not mean a smooth ride, quite the opposite, but it does mean that investors who accept volatility and who plan on multi-year horizons may be positioned to capture significant upside as allocation dynamics normalize. It is equally important to appreciate how this cycle is unfolding beneath the surface of headline prices. Historically, bullion tends to move first, and mining equities follow once operating margins improve and capital begins to flow down the hierarchy of names. In the current cycle, that flow has accelerated, with money reaching smaller producers and even well-capitalized juniors far more quickly than in past bull markets. That acceleration matters because it changes where value will be created and how fast market participants must act. The opportunity is no longer confined to the majors. It is playing out across the full spectrum of producers and developers, and careful security selection is becoming more valuable, not less. Finally, consider the institutional conversation now taking shape. When high-profile allocators and influential strategists publicly entertain double-digit allocations to gold, they are not merely offering a speculative idea, they are redefining the benchmarks against which portfolio risk is measured. Even if a 20% allocation remains a low-probability event, the very suggestion signals a recalibration in thinking among sophisticated investors. For anyone building a long-term asset allocation, that intellectual shift is as important as any short-term price move, because it changes the odds on which future flows will be predicated. In this video, Rick expands on volatility, the mechanics of money moving down the sector, and the practical choices large investors make when they prefer owning physical metal over paper exposure, practicalities that go straight to how premiums, delivery logistics, and market structure evolve as demand scales. If you want a clear, no-nonsense walkthrough of those mechanics and what they mean for where to look next in the sector, stay with us. And if you haven't already, hit subscribe and the bell so you don't miss the detailed breakdown that follows.
Gold historically is extremely volatile. I think that the underlying trend in gold is up because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade, and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher.
What makes what we're going through right now so exceptional?
I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Ma's and Pa's, but foreign central banks. You'll notice that right after the move, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the U.S. Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the U.S. Treasury market. And as we've seen, really, for at least 5 years, it has been disintermediation from U.S. Treasuries into gold that has been responsible for the strength of gold. And that's continuing. Traditionally, gold bull markets follow a very predictable pattern. The metal moves first. And that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022, as an example, the gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold, and they don't buy gold stocks. So a market that had a bid went up, and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed in the market in 2025. In a typical gold bull market, it goes like this. Gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated. What happened in the prior bull markets in my lifetime is that the best of the best moved first, and they attracted market multiples, market capitalizations that were excessive relative to the rest of the sector. And so valuation arbitrage would take place. Guys like me who said, Newmont is cheap compared to Agnico, would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over the smaller guys. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down, even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years, and it's interesting, and I don't really know why it's happened. Perhaps it happened because that sector was so ludicrously oversold. Perhaps it happened because life of cycle bottoms in 2021 and 2022 were farcically low, and what we've seen in the juniors is a dead cat bounce. I'm not sure what we've seen, but what I have seen is that the best of the juniors have all taken advantage of these higher prices to come to market to raise capital. And for the best of the juniors, all of these capital raises have been substantially oversubscribed, which tells me that the money is present in this bull market, and the gold bull market is really, truly underway. It also tells me that investors need to be more careful. If the price of a company doubles without any change in the fundamental news around the company, it is, of course, half as attractive as it was before the price doubled. And so people need to pay attention to that. They are no longer in the easy money part of the cycle. The easy money part of the cycle is when companies go from being hated to being tolerated. And gold is certainly no longer a hated asset class.
If your horizon is measured in years rather than days or months, The arithmetic of declining dollar purchasing power and a persistent mismatch between supply and durable demand argues for a materially higher price trajectory over the medium to long term. That is why Rick is unequivocal about framing precious metals as a multi-year allocation decision rather than as a short-term trade. Looking ahead to the next section of Rick's interview, the critical dynamic is who is doing the buying. When large pools of capital, sovereigns, major family offices, institutional allocators decide to take physical metal seriously, the market shifts in a fundamental way. Paper inventories contract, physical premiums widen, delivery becomes a more salient part of price discovery, and the balance between ETFs, allocated storage, and direct bullion ownership changes. For investors, understanding where the demand is coming from and which channels are most likely to tighten. First will be the difference between being an early beneficiary of structural flows and being left chasing momentum after the fact.
Has this not occurred before in previous gold bull rallies where energy prices have gone sideways to down while the gold and precious metals prices have gone up?
Yeah,
Is this,
that's not necessarily inconsistent philosophically. Oil prices often move as a consequence of broad economic trends. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated or at least ignored. Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile.
Some executive at Morgan Stanley that recommended a remix or a venture out of the typical 60-40 into a 60-20-20, 60% stocks, 20% bonds, and 20% gold. I mean, gold has been severely underallocated for the past few decades. What does it mean when serious investors like that begin allocating 20% of their portfolios into gold?
The last statistic I have was from J.P. Morgan Chase. And J.P. Morgan Chase said that the overall, the global allocation to precious metals and precious metals equities in the U.S. was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities. Mm-hmm. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand. Mm-hmm. I have no idea what a 20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%, and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil.
Is that something you would do, Rick? Would you allocate 20% of your portfolio into gold?
If you look at my own portfolio now, first of all, somebody who looked at my portfolio would say I'd be a moron to own physical gold. Because as an example, I'm the largest shareholder of Sprott, a brand name for gold.
Mm-hmm.
My allocation to gold and gold equities is higher than 20%. But that's partially because of my economic prejudice and partially because I've spent 50 years coming to understand the gold bull market. For me, it's at once an investment, a speculation, and a vocation. I do all those things. I wouldn't encourage your audience, most of whom have lives, to be as over allocated to gold and natural resources as I am. But that's what I do. If you have a listener who owns a plumbing company, he or she focuses a lot of their life on running a plumbing company. In addition to being a philosophical adherent to gold, my plumbing company is a gold financial services business. So I'm way over allocated relative to the norm in precious and resources.
Rick Rule's analysis leaves little doubt that precious metals are positioned for a significant re-rating. The mathematics of allocation alone are persuasive. With U.S. portfolios holding just 0.5% in gold and silver, even a return to the long-term mean of 2% would imply a fourfold surge in demand. In an era where inflation is eroding real purchasing power and bonds guarantee losses after adjusting for inflation, the appeal of metals as a defensive yet opportunistic allocation is undeniable. Equally important is the speed at which capital is cascading through the mining sector. Unlike past cycles, where money moved gradually from bullion to the majors and only later into the juniors, this time capital has reached smaller producers and developers far more quickly. That acceleration signals two things: investor appetite is broadening, and valuations in certain parts of the market are already adjusting. For investors, this demands discipline, separating companies with genuine operational leverage from those simply riding momentum. Taken together, these dynamics point to a rare asymmetry: limited downside for long-term holders paired with outsized upside potential if institutional allocations continue to rise. For investors who can withstand volatility and focus on fundamentals, this may be one of the most important opportunities of the coming decade. If you found this breakdown helpful, make sure to subscribe and join the conversation in the comments. How are you positioning for this metals cycle? Your insights help shape future discussions, and together we'll continue tracking one of the most consequential investment stories of our time. Thanks for watching.